The most startling thing to me is really what's happening in bonds. First of all, we talk about rates going down, but I think the funny thing is, or the odd thing, is that no matter how much the Fed has cut, and the Fed's cut a pretty decent amount already, and we know that they're planning to cut more, but it seems like everyone has missed the fact that the 10-year rate doesn't go down. The 30-year rate hasn't gone down. The 30-year rate's still trading around 475, and it's just basically 25 or 30 basis points away from being back at the highs it was at not that long ago. And even on the 10-year rate, it's only 50 to 75 basis points away. I mean, in the market today, that could move very quickly if it were ever to revert. With the terrible ADP jobs data we got today, you didn't really see a very big reaction in the bond market from it. And I think that's a really important and telling thing. It's telling us that the market and I've kind of theorized this again with my subscribers for a long time. I think 4% on the 10-year is the floor for it. And the reason why I think it's the floor is because the curve is simply too flat. And I'll pull up my chart again. So if we look at a chart of rates, if we look at a chart of the 10-year minus the 3-year, the 10-year minus the 3-year is only separated right now by 33 basis points. That's it. Why would anyone want to go out and buy a 10-year bond when they can just keep rolling over 3-month treasury bills on a regular rate, on a regular, time scale, and only be losing 33 basis points, avoiding all that risk that comes associated with owning a longer duration bond? This yellow line marks the zero bound. Now, I want to show you something, right? If we go on a weekly chart now, this is going to show us where the curve is on a historical basis, right? We're all the way over here. Notice that the curve typically peaks around 385 to 400 basis points above. The 10-year normally peaks 385 to 400 basis points above 3-month treasury rate. If we use the Fed funds rate as a proxy for where the 3-month treasury rate will be, I mean, let's just say the Fed funds rate bottoms somewhere around 3%, which is what the market is pricing in right now. So if the Fed funds rate bottoms at 3% and the 10-year, and we use the 3-month as a proxy, it means that the 3-month would probably also be around 3%, which is 70 basis points. That would still only put the spread at around 100 basis points. So we would be somewhere around here when historically we're somewhere around here. So unless the Fed is going back to zero, the curve is too flat, even if the Fed cuts. And so this is why I think bond yields at the back of the curve haven't gone down nearly as much as people think they're going to go down just because the Fed is cutting. Here's the 30-year minus the 3, and it's really the same thing. It typically peaks nearly 450 basis points above Fed funds, above the 3-month treasury bill. So again, if they cut another 75 basis points, that's going to put this somewhere around 175. You're still only halfway there. At a 3% Fed funds rate and a 3% treasury bill rate, you would think that the 30-year would be closer to 7%. And I think that's why you don't see rates going down at the back of the curve, mostly because the market is basically not sure exactly where the Fed ends up cutting. Because right now, the way this thing stand, the curve is too flat for where we are in this cycle. My guess would be is that we're likely to see, and we're not talking about post-GFC. We're not talking, these values aren't all pre-GFC. This is 2011. This is 2014, right? Rates were at zero. That meant that you had a 30-year rate in 2014 at 388, 389, basically 4%. So again, if the Fed's going to stop cutting at 3, then the 30-year should probably be closer to 7. If the Fed's going to stop cutting at 2, then the 30-year should still be somewhere around 6. What it tells me is that this is the reason why you're not seeing rates on the back of the curve going down.